Welcome to my TED Talk. I have a little juicy presentation about the whole situation going on in the economy, oil, macro, whatever. Want to see what we can do. So we want to grow on different metrics and just wanted to share some insight on what to look at. So this is going to be like a highlight presentation kind of deal. And usually pop up my fear and greed index from CNN Business. Kind of gives me a view of where we are. Simple tool. Wouldn't necessarily say that's the only key point, but you could look at it. And as you can see, there was even more extreme fear some time ago. Look at the timeline, pretty greedy. Back in time here, extreme fear, and also around here, it's not that bad compared to from like a couple months ago. The 125-day moving average just hit under that level a couple days ago. Or at the start of the so-called Hormuz Strait deal, see stock price strength going down, stock price breadth going down, put call options ratio gone up. I mean, it's kind of been trending. You have some market volatility, so safe haven bank that we're going to hit at some point again, and it's going to be interesting. Junk bond demand, it's pretty interesting what's going on. I mean, high spike back to a little bit lower. So, why are we talking about all this? Well, oil crisis looks most like something like a mix between 1979, 1990s, and 2022. So, look at the crude. We got, I would say 1979 is the closest match because this is a geopolitical supply shock, not only just oil rising on strong demand. So the whole global oil supply, it's like 15 at this point. That's kind of paralyzed, so to speak. What it looks like today, like hit 111, was about 57. Pretty steep climb. Looks more like the 2022s. You can also see what happened here. I'm not suggesting it's the same. This peak 90s. So 1990s also fits because the market reacted violently to Middle Eastern disruptions without like automatically becoming a full decade-long inflation regime. And 1973, kind of a warning sign, but not yet the best direct comparison unless this drags out much longer. So, you look at gold. What's going on? Pretty crazy trend overall. If you just look at it 5 years perspective, but let's just look at it from a year-to-date perspective. Kind of hit a little bull run here, and what's interesting is we've gone down, and this recent spike, I think that's kind of interesting to look at. I mean, if you look at it yearly, it's not like a big move. 10-year treasuries, it's kind of flat, but still, we had a like pretty big hike from here to there. 2022, like historical hike. Look at a 10-year perspective, pretty crazy. And look at a max, we're still flapping around, but I mean, comparatively to look at the 1990s, they try to hike into the oil issue, which is interesting because they had the whole inflation deal. Why this all matters? I mean, this is not like higher oil, healthy economy. This is higher oil because supply is just disrupted, which is much more dangerous for stocks. So once oil stays high long enough, the market stops thinking about energy profits and starts thinking about inflation, slower growth, stagflation risks, recession odds. So, I mean, looking at the US Consumer Price Index, this is a cheeky one because as you can see here, kind of went up. And the first scenario we talked about, 90s, went down because they tried to hit the rate. Historically, stock market patterns are oil shock hits, energy spikes first, inflation expectation rises. This is essentially just the inflation comes from the oil, trickles down into the economy through other vectors like plastics, consumer goods, and what have you. Um, and although it's not part of the core inflation, it pretty much becomes it over time. But it's kind of an issue because the Fed, they can't they can't print hydrocarbons to get this issue out of the way. So water equities weaken, and bonds do not always protect. It's not like an automatic safety just because, oh, it's bad times. And this is like little twists because you have these Middle Eastern countries which have a lot of money in private equity, a lot of money in US treasuries. That is kind of an issue if they drop that. You also have money taken out of the whole private equity thing, which we also saw a couple weeks ago. So if the shock lasts, growth fears take over. You'd also look at the whole AI thing going on. You've probably seen a lot of videos going about this circular economy thing with AI and retail throw money at AI stocks. They use that as leverage, more money into the system. Look at a historical chart. I mean, I wouldn't be like really scared. You just have to have a balanced portfolio. You can see technology, the light blue one, has kind of had a nice ride, but not uh, as much part of the S&P 500 as the rest. You call it Mag 7, whatever you want, but the technology sector has kind of gone off the rails after 2020. Like here, inflation basically just kept capitalized into the general stock market and still kind of followed in 2022. Had this divergence from the rest of the stock market ever since. It's taken a beating right now. You can see gone lower. Still kind of holding up, but not really. I mean, well, let's see. Big stock market takeaways: at first, energy wins. Later, the whole market starts feeling the pain. The longer oil stays elevated, the more it acts like a tax on the economy. So, but I mean, you shouldn't worry that much because looking at the interim performance, if you have a balanced portfolio, I'm not meaning like a 40-60 split with bonds and stock 60. I mean, if you have allocated your funds to different sectors, you're pretty good in general. But I mean, if you count these, you have like so many 68 ups and 32 downs. So I mean, you could dollar cost average into whatever you like. Sectors that usually win first are energy defense. This is what we have seen. Gold has kind of had it, and sometimes does well. Later, the more defensive rotations are into like healthcare, consumer staples, and utilities. So these are like they're gonna sit well for a long time, just like when 2020 hit. Those are the good plays because you don't know what's going to happen. People need this. The important nuance here is in normal risk off events, bonds often rally, and in an oil shock, bonds can struggle because inflation rise and growth weakens. So it kind of makes this crisis harder than the normal market pullback. And kind of say the best framing line, this geopolitical supply shock with stagflation risks not yet fully locked in a stagflation regime. There's like two scenarios. The crisis worsens, more upside for energy, more pressure on broad equities, and greater chance of a sticky inflation. I mean, you can't really do anything. The rates are high. The Fed said they will stop hiking. It's not part of the core inflation. It's the energy inflation except for defensive stocks becomes more attractive and market starts pricing at late 70s style problem. So let's just say the crisis fades. What do you do then? Well, it's kind of like more like a 1990s or 2022 scenario. Oil cools, the airlines and cyclicals bounce in a positive way. The episode becomes more of a volatility shock than a regime change, so to speak. So, what's like the best line? Fork in the road. And disruptions could be temporary. It's more like 1990s, 2022. If the oil stays high for longer, it becomes more like a 1979. So this is not recommendations. These are things that you could look at if you want. It's not financial advice. So energy sector ETFs, you'd have a more direct oil fund. Doesn't really matter. Could also be ConocoPhillips, whatever. Defense exposure to. I wouldn't necessarily invest in a lot of this right now because just generally it's high. I mean, you could probably get a little extra bang for your buck. You have the whole issue with the shipping routes that are being blockaded, and that just means that you're shifting the whole shipping part a lot of months out into the future. I'm not necessarily inclined to think that this is priced in because it's hard to price in how much effect it will be compounded by it not reaching shores with the extended timeline being pushed day to day. If the escalation happens, or I mean de-escalation, you have healthcare sectors, and you could also do like jets, airliners, just like on the COVID, when the oil came back, it was like, whoa, jets go down, go up again. This is like a shorter time frame. If you're just like, oh, it's probably just a dip, you could do something about that. Do the Metas, the Microsofts, well, Magnificent Seven, whatever you want, and probably get a good deal, but you don't. You don't really know what's going to happen. So I would probably dollar cost average into something like that, and just have some of these protective hedges on hand. So the market's not just pricing expensive oil, it is pricing the risk that expensive oil becomes persistent enough to damage growth, keep inflation sticky, and change the entire market. So that's pretty much it. See ya.